Mark my words, this is a powerful video. This is in fact one of the most important videos you will ever watch regarding finances. Did you know that many people have become millionaires in the last few years in terms of their net worth? It is hard to tell when you look at them, but who cares about appearance? The important question, however, is how did they become so wealthy? What is their formula? I will tell you right now. I will disclose every single step. First of all, I would like to thank my friend Arjun, whose content was an inspiration for this video. Arjun runs an amazing channel called Finance with Arjun. His channel is among the best when it comes to financial education. He covers a variety of topics that include stocks, passive income, money management, expenses, taxes, credit cards, and even cryptocurrencies. I have learned a lot from him, and I guarantee you will too. So definitely subscribe to his channel. A link for his channel is given in the description. So are you on H-1B visa, or are you about to start your life and career in the United States? See, the point is that the salaries in the US tend to be the highest in the world. But just because salaries are high, it does not mean that it will all go into your pocket. What you do with your money on a regular basis will determine whether you become millionaire and wealthy. One underlying aspect among all the millionaires is that they invested their money in the right way. So what is the best way to invest? How should you time the market, or should you? Let's find out. I will put forward 4 case studies, okay? And carefully listen and understand each of these 4 cases. All 4 cases though come at the 3rd step. So what are these 3 steps? Step number 1. Focus on building your emergency savings first. Market can go down, or you might have to face some emergency. So it is very important to save at least, to start with, 3 months of your expenses. You can always build on it later, eventually, until you have 1 year of expenses in your savings, but at least start with 3 months of expenses and not worry about anything else for now. Step number 2, once you have achieved at least 3 months of savings while you are building on your savings, now focus on starting to pay your loans back. Okay? Try and get rid of your debt as soon as possible. If you have a car loan or a student loan, try and get rid of it as soon as you can. And finally, the important step is step number 3, is to invest the right way. What is this right way? Let us take example of 4 different people. Each of these 4 are different from one another when it comes to their savings and investment strategies. So it is important to examine how their strategies work over long term. Let's take a long period of 40 years and examine how each of these strategies will play out. The 4 characters in our case study are Viru, Basanti, Thakur, and Gabbar. Now let us assume that each of these 4 people put $200 away every month in the form of either savings or investment. So let's say they all started investing in 1980, where they were putting $200 away every single month. So $200 over a period of 40 years is equivalent to $99,000. Okay. Now this is just $200 put away. So let us look at each of their strategies and examine how those $99,000 over a period of 40 years would have turned out based on how these people saved or invested their money. So our first example is of Viru. Viru never bothered about stocks. Okay. All he cared about was how he can save all that money into a savings bank account and reap benefits of those interest rates. So every single month, Viru only put $200 in his savings account over a period of 40 years. Now, since 1980, when our data starts, the interest rates have varied a lot. As you can see, in 1980s, the interest rates were very high. In fact, they were above even 10%. There is no way you can get those rates today. Today, the rates are much lower. If we take an average of 3% over a period of 40 years, how much money would Viru have had he put all that money in his savings account? Taking 3% average interest over a period of 40 years, that $99,000 would be equal to 190K in his savings account today, which is a good money, right? Wait for other examples. Now, the next 2 people, Basanti and Thakur, always try to time the market. That is, they buy and sell based on market crashes. Now, there were 5 major market crashes in the last 40 years. First was the Black Monday in 1987. The second was Kuwait War in 1990. The third was the famous dot-com crash of early 2000s. Then we had the financial crisis in 2008 period. And then the most recent was the COVID crash in February-March period of 2020. Basanti had magical powers, and she used her clairvoyant abilities to her advantage. She somehow knew when exactly the market would crash and time her purchases at the lowest point right after the market crash. What Basanti did was that she put $200 every month into savings, and the moment market crashed and the moment it was at the lowest point after market crash, she would invest all that saved up money into index funds, let's say Standard & Poor 500 index. And then she would hold on to those index funds and then again would start saving until the next market crash. For example, she had been saving money since 2008 market crash until March 23, 2020, when the market was at its lowest point after COVID crash. She put all that money into index funds. Now let's be real, this is an unreal hypothetical situation and it is very difficult to pull it off. But because Basanti had magical powers, she was always able to predict the market crashes perfectly. Now because Basanti had the best possible luck, what would have happened to her $99,000 that she put from her own salary? So if Basanti put $99,000 at the bottom of the market crashes, she would today have $1,123,573. To round it up, let's say Basanti would have $1.12 million, which is more than 10 times, okay? After Basanti's magical powers, let's transition to a third case, which is of Thakur. Now, Thakur had the worst luck possible. He had the worst possible market timing. Now, this is going to be very interesting, all right? Now, what Thakur did was exactly the opposite of Basanti. Thakur saved up all his money, and just before the market crash, when the market was at its peak before the crash, he would put all the money into index funds. Okay, all the money that he had saved from his previous investment, he would put it all in one go. So Thakur saved up all his money starting in 1980 and then he put it all into the market in 1987, just before the Black Monday crash, when the market crashed by a whopping 33%. Thakur's timing was so bad and he was so unlucky that he kept repeating the same mistake for 4 more times, where each time he saved up and put money into the stock market in index funds right before the crash. With as horrible timing of Thakur, what do you think might have happened to his money? How much would be Thakur's money worth today if those $99,000 were invested with such horrible timing? The answer is $773,358. For simplicity, let us say 773K. So even with such horrible timing over a period of 40 years, Thakur money grew by almost 8 times. And that happened because Thakur held on to his investments over a long term. And because he invested over long term, his investments recovered those market crashes and then they grew. And each time his investments surpassed the peak points at which he had put that money. Finally, we have our favorite guy Gabbar. See, Gabbar was not interested in timing the market at all. He was just consistent with his investments. So what Gabbar did on his day one is that he started to put $200 where he put auto transfer from his bank account to his investment accounts, and he would put those $200 into index funds every single month for those 40 years. He never bothered about the market conditions. If the market had peaked, he would put $200 into index funds, and if the market had crashed, he would still put $200 into his S&P 500 index fund without any thought or consideration. Because Gabbar did not use his brain all that much and was just consistent, he had fun. Gabbar was riding horses, playing with his friends, and then he was also watching some interesting dance movements. All that fun he was having. So how much would Gabbar have after 40 years of his investments? How much would those $99,000 would turn into? The answer is that Gabbar's $99,000 investments are now worth $1,629,708, which is $1.62 million. Do you get the picture? Gabbar never bothered about the market conditions. In fact, our market timer, the perfect market timer Basanti, made $1.12 million and this guy made $1.6 million, $500,000 more just by being consistent and not trying to bother about the market conditions. Let that sink in. Let us do a recap. Each of our 4 characters either saved or invested $200 every month over a period of 40 years into their savings account or 500 S&P index. Viru, who only saved money, ended up with 190K. Basanti, who timed the market perfectly, ended up with her investments worth 1.12 million. Thakur, who had the worst timing, had his investments priced at 773K. And our favorite Gabbar, who invested regularly no matter what, had investments worth $1.62 million. So, what are the most important lessons for us? The first lesson is that compound growth is very powerful. Just 99K grew to more than $1 million over a period of time. Over time, the contributions became smaller and smaller portion of the amount of money that was already invested. The second important lesson is that everybody outperformed our saver Viru. I know I said that you should save some money. It is important, but you should not only save money, because let's be real, if you just save money, usually the inflation rate is always greater than the interest rate that you will get in banks. So the more money you have sitting in bank over a period of time, the less worth it will be. Although it is very important to save some cash, but my suggestion would be to save no more than your 3 years of rent, and this is at the extreme value, okay? Or at least 1 year of your expenses. Beyond that, putting so much cash into your bank account will actually hurt you, because your inflation rate will definitely beat your interest rate. The third lesson is that a regular investor like Gabbar is much more likely to actually exist than perfect timer Basanti and horrible timer Thakur, because it is nearly impossible to be such a perfect timer and to be such a horrible timer. What Gabbar did, I can do it, you can do it, and anyone can do it. Because remember that Gabbar used simple logic and did not bother about timing the market at all. Now, a fifth character is also possible, okay? And the fifth character is Jay. What Jay did is that he would save up all the money and buy at the lowest point in the market, and then just before the crash at its peak, he would sell all that and use those savings again to invest at the lowest point. Hardly anybody can ever do it, so don't expect to try and time the market. Practically speaking, it is downright impossible. So the conclusion is that you should not bother about timing the market. In fact, time in the market always beats timing the market. So simple formula of all these wealthy people is that open a brokerage account and start putting money early and do it consistently, and hold on to your investments for a period of at least 5 years. Over time, the market keeps growing and your likelihood of losing money becomes minimal. Now, one thing to keep in mind is that in all these examples, people were only investing in index funds. If they also invested their money in some good stocks, they would be much richer. Stocks like Amazon, Tesla, Microsoft and Apple have made many people millionaires. Therefore, an even better strategy would be put some money into index funds and put some money into stocks. How you should make that balance, I will leave it up to you. I can share my personal views on that in a later video. For the time being, I hope this video helped you. Thank you for watching. Jai Hind and God bless America.